to accelerate the journey to achieve climate change goals, even though the evidence is not conclusive, partly reflecting the absence of regulatory framework that might mitigate the risk of greenwashing and incentivize compliance with firms' declared commitments to greening their activities. With this in mind, the recent progress towards the adoption of common taxonomies of green activities and related disclosure and reporting requirements for the corporate and the financial sector can help mitigate the risk of greenwashing. However, some of the envisaged policies we believe might also have the unintended consequence of increasing the cost and hence reducing the supply of private capital for the green projects. This interesting circumstance is what is related to our today's discussion. The research shared today will be delivered by Mr. Bram van der Kroft, and he will be interestingly shows the underlying mechanism of the variance in ESG ratings and even uncovers an inverse relation between ESG ratings and sustainable performance. So this paper also claims that the directional incorrectness of ESG ratings fundamentally differs from the previously observed variance by questioning the use of ESG ratings in academic literature and practice altogether. So this is, I believe, very interesting. Before we start, and I introduce the speaker of today to all the participants here, Bu Desi, would you mind to say something first, or is there anything that you want to convey before we introduce the speaker today?
Okay, thank you, Bu Valen. Yeah, good afternoon. Good afternoon, good morning, Bram. Thank you for your willingness to share with us. Thank you, Bapak Ibu, our lecturers, our students, for your kindness to attend our academic talk, PPIA academic talk, Bincang Akademik PPIA. So we routinely, if there are hot topic, in the research area, we routinely provide or arrange this event, to give some insights about the hot topic in research regarding ESG or taxation or governance, so that our students and also lecturers can be updated with the hot topics in accounting. And for those of you who are not from UI, maybe I just want to shed light on our program. So we are postgraduate program in accounting. We have the master and doctoral program, and of course we are research based. So that's why we are actively conducting several academic talk, or research activities. And you may find us in website Universitas Indonesia or Faculty of Economics and Business Universitas Indonesia. And currently we are still in admission period, still please wait for the further announcement. And for this event, I would like to deliver my gratitude to Bram. Bram, you are also a student, right? So we hope that, all of our students here can also learn from you how to think critically and how to write a paper which is important and interesting, and also maybe you can share how you manage your time, because I saw in your CV you have the time to become, what is it, in MIT, right? You become the visiting student or visiting researcher, in MIT, while also doing your PhD. So we hope that we can learn much from you. Okay, that's all from me. Thank you very much. Please do enjoy this event. Okay, thank you, Bu Valen.
Thank you, Bu Desi. So let me introduce Mr. Bram van der Kroft. He's a PhD in finance at Maastricht University and Open University. He has been on exchange at Massachusetts Institute of Technology with his research area concerns in sustainable finance, and in particular, socially responsible investing, ESG, and corporate social responsibility. So without any further from me, let us all welcome Bram van der Kroft, and the time is yours.
Well, thank you so much for the so welcome and heartfelt introduction. I really and greatly appreciate it. And thank you so much for the ability and time that you spend all here to listen to me just talking. So I greatly appreciate the setting, and I hope that I can teach you something useful today. So my research in general broadly concerns the environmental, social, and governance performance of firms, also sustainable performance. So basically, how firms contribute not only to their bottom line, but also to the society at large in addition to that. And these questions are really quite interesting. And I'd like to guide you through one of the examples, how that is very well intended, but somewhat less well executed. And that's primarily the focus of today's topic. So if I were to quickly go to the slides, then so the paper that I'll be presenting to you today is called Tilting the Wrong Firms, How Inflated ESG Ratings Negate Socially Responsible Investing Under Information Centuries. This work is joint work with Professor Dennis Bums, and we've presented it at a number of conferences, so its paper is relatively well seasoned. I'll do something today somewhere in the combination of a lecture and a paper presentation to keep it academic, but also to give a broader context so that everybody can follow. And as with any presentation that I give, if you have any question throughout any point, jump in, open up the mic, otherwise it's going to be really boring. So please speak. This is here for you to learn and for me to also understand how you think. So at any point in time, don't hesitate, unblock the mic and ask a question. I'd like that. It's interesting and it gives a nice discussion. So thank you so much for being here, and let's start the presentation. So to quickly get everyone on the same page, right? We're dealing with climate change. Some regions of the world are particularly subject to that. Specifically, parts of China are really, really at risk, parts of India, but also Indonesia, given flood risk and stuff like that. So there are genuine concerns about our society moving towards a higher temperature environment. And this has large influences on how we live, how we do business, where it's safe to live. One example is that, for instance, in India, the life expectancy is expected to go down by about 7 years just due to air pollution at the end of the century, which is huge. Like 7 years it's massive. It's really, really, really big. Going from the worst to the highest life expectancy difference is somewhere in the region of 35 years. It's twice as bad as smoking. That's the consequence of just air pollution and the increase in temperature. So we're really got to have to do something about it. And as I'm from finance, the reason and the starting point of this talk is let's go about it from an investing perspective. And you might think, well, these investors, they just only want to make money. Initially, I would have thought the same, but now I'm not so sure anymore. As you can see on this graph, which is just for the US, you see the amount of money that is invested in a socially responsible way. And that has increased by about a factor of 20 to 30 over the last 20 years. Initially, less than half a percentage point was invested in socially responsible assets in 1995. And nowadays, in the US, which is not the most sustainable country, a third of assets under management is invested in a socially responsible manner. In Europe, estimates range between 50 and 60%. So investors are largely shifting their assets in a way that tries to do something good. And this is very, very promising. So what do they actually do, right? They focus on E, S, and G. You must have heard this term a number of times throughout your courses at the wonderful university that you're at, and you must have gone through some aspects of sustainability in your coursework. Now, the thing is, E, S, and G is very little and very much, and all at the same time. In the environment, you have the climate change risk that a firm has, but also the climate change risk on the firm. You have the pollution that it has, the waste that it produces, but it could also offer environmental opportunities. If you're very good at making recyclable bottles, then, well, nowadays that's a pro, and you probably get more money for it than you would have had in the past. From a social perspective, it's even maybe more important. It's how you deal with the people around you, around the firm, and the people in the firm itself, the employees and the neighboring stakeholders. If you're having a very large polluting plant, it's going to be bad for the environment, but also bad for the people that live there. And if you let your workers work a lot, as is still happening in many developing countries and also sometimes in developed countries, it can be quite damning. So having a good social impact is really important. Nowadays, we're mainly focusing on E, but S is equally well a very big problem. And then we have the governance, which is honestly kind of solved. As of 2001, 2002, 2003, early 2000s, we have solved debate. You need to have an exogenous board, you need to have a certain structure. It's kind of resolved. It's still in there because the person at the ECB claimed the term ESG. But yeah, it can be important. Take a look at a firm, right? Just imagine a firm that everybody thinks is very sustainable. Can you give me an example? What is a firm, if you say sustainable, that comes to mind very easily? Anybody driving a car?
Yes. The firms was basically committed to these three things sincerely, substantively, do you think?
That differs. I have another paper that shows that some of them really are and some of them really are not. But one example of a very sustainable firm you could call Tesla, because it makes electric cars, which don't petrol, which is really good. But I don't know how good its governance structure is. You have one guy that runs the show who can basically kick out anybody he likes. He just buys a random tech company that is totally unrelated to having cars just because he suddenly thinks freedom of speech is very important. And then he monitors it himself later on. And how does he treat his employees? He took over the other firm. He just kicked out half of the people. Is that really good social performance? I don't know. If even a firm that most of us think are very sustainable is maybe not as sustainable as we think it is, then how exactly do we assess this information? We as retail investors, we can't, but maybe institutional investors can. There's also some research that puts this into doubt. So because there is so much information out there, you get a market for lemon type of thing, because nobody really knows what's exactly going on. There's information asymmetry, and there's so many uncertainties and different things you need to put together that it becomes really, really difficult to align all of this. And to resolve this issue in society, there have become an increasing number of ESG rating agencies. These rating agencies basically try to put together all of this information in a way that becomes very efficient, which is good. It's really good that we have a measure. If it would work, it would make life tremendously easier. Since these ratings became more prominent, investing in socially responsible things became more prominent too. I don't know whether one of them followed the other. I don't exactly know the causality here, but at least it eases the way and the extent to which investors like you and me could invest socially responsibly. We cannot, for every firm, dig deep and investigate how sustainable they are. We need to have a team of 100 people to do that. So as a big bank, that's maybe possible. But as another investor, it's not. So these ratings are supposed to reduce information asymmetries. But really, are they? So socially responsible investing is basically a way of investing that gives you a different trade-off between sustainable and financial performance. You don't only care about how much money a firm makes, but you also care about how it performs in terms of ESG, how its sustainable performance is. And these investors do so in two ways. They either engage with the firm, they buy their stock, and then they say, okay, we're now a shareholder, you're going to change. And then they force the firms to change. Or they tilt their portfolio. They buy the good ones and sell the bad ones. Carrot and the stick. And by doing so, they change the cost of capital of these firms. And that is precisely the mechanism that we'll focus on today, this portfolio tilting. Are there any questions so far?
So what you're trying to say here is the fact that ESG is not a guarantee that the company is actually sustainable enough, like Tesla, for example. And what you did is
the ESG rating. Yes.
Yeah, ESG rating. Yes, as a rating itself cannot be a guarantee that the sustainability is actually exist.
Yes, and the reason why I'll get to in a second, but that's my main claim of the paper, and that has consequences to this investing. So
Okay.
how it would approximately work is something like this. So you have a whole bunch of investors. These are normal investors. And these normal investors, they care about just the financial return. They can invest their money, 200, in two types of firms: green production facilities and brown production facilities. And because they don't care about sustainable performance, they would equally allocate the money, giving both firms a similar cost of capital. This is basically a measure of how much money you need as a firm to attract new money in order to invest in a certain way. The higher the cost of capital, the more risky and expensive a project is. So if you have a low cost of capital, you can pursue more projects and then grow as a firm. This is how cost of capital works. But now suddenly investors turn green. And what you see is that these investors tilt their portfolio toward more sustainable assets, for which as a result, the cost of capital of these assets goes down and the share of green assets in the economy goes up. That's the generic principle of portfolio tilting in socially responsible investing. Now, what we claim in practice is that it's actually very hard. As we just mentioned, for basically a firm that is renowned to be very sustainable, we can still have question marks. There's a lot of information asymmetry. There are a lot of things that we don't know about. Keeping to the car industry, BMW and Volkswagen had a very large carbon scandal where they emitted a lot more than that they thought we thought they did. And then if all of this is going on, it's just something that's very key to their business model. What are they doing on aspects that are not key to their business model? What are they doing in things that we just simply don't know? And firms don't always want to report everything. If it's really close to the business model, it may be a trade secret, which you don't want to tell your competitors. And if something goes bad, you might want to keep it quiet as long as possible and hope that nobody notices. Or you may be honest about it and tell everything. It's very difficult to assess how somebody is really doing when there are information asymmetries. Now, Hartmark and Sussman in the 2019 JF paper show is that these socially responsible investors actually use these ESG ratings to invest in a responsible way. So they really use the ratings to make their portfolio choice. Now, when there's a lot of information asymmetries, so we don't really know which firms are sustainable, and we use the ratings, we provide incentives for firms to basically increase their rating, but not their sustainable performance. And that's the mechanism that I'll focus on in this paper. So it will look something like this. Green investors don't know which is which. They hope that the highly rated ones are the good firms. Now, what I find in practice is that it's actually the brown firms, for which, as a result, the brown firms will do better compared to the green firms. And what I basically find in the paper is that there is ESG rating inflation throughout the globe. It's really persistent, and throughout the board it holds, unfortunately. Then I take a look at whether investors are actually fooled by it. Because if the ratings don't work, but investors are not fooled, then there is no problem, right? I mean, if it's just a bad measure and nobody uses it, there's no consequence. But what I find is that they actually follow these bad ratings, and particularly the socially responsible ones, not the other firms. And as a last thing, I look at the cost of capital implications. So if you're a firm and your rating Do you actually get something out of it? The answer is yes. So by doing so, we contribute to the debate on socially responsible investing. There are a lot of theoretical models that argue that engagement is better than tilting, and that there's a lot of debate here. But now what in essence we argue is that, well, we should include information asymmetries in these models. What if investors don't know? Well, what we find is that if these investors don't know which firms are responsible, it's really bad to do portfolio tilting because it might hurt rather than help these firms. Therefore, if you have to take a gamble, engage. Because even if you accidentally choose the firms that are already sustainable and you engage with them, you're still going to do some sort of good, I hope. Whereas with tilting, you might actually harm these socially responsible firms. This is also clearly reflected in the work of Alex Edmonds and Jan Scheenmeyer in their 2022 working paper. I talked with them extensively, and they also have this extension in their work where they show that basically the investment doesn't work if there are many information asymmetries, which might accidentally target the wrong firms. So it really aligns with this literature pretty closely. Then you have to work on the ESG ratings, which primarily argues whether and how ratings diverge across multiple rating agencies. So the work of Florian, Julian, and Roberto in their 2022, I think, Review of Finance paper. It's really excellent. What they argue is that there's divergence across ratings because they measure different things. I go one step further and argue that there may be just divergence, but these ratings are actually inversely related to sustainable performance. And this questions their use in academic literature and also in investing practices. I've talked to a couple of policymakers and bankers over the last couple of weeks, and they really, ask me like, okay, well, if we can't use that, then what do we do? And honestly, that is tricky. I can give them my measures and hope that that does some good, but we need a structured solution with better reporting to actually resolve the issue. So, roadmap for today. After this long introduction, I hope that everybody is a little bit on the same page. So what are we going to talk about? Well, first, I'm going to tell you how I split two parts of sustainable performance, what firms promise and what they realize. Then I show you how I use that to identify rating inflation, and I look at the consequences on portfolio tilting and cost of capital. Any questions so far?
Bram, maybe before we continue, I'd like to ask, we here use the ESG ratings from Refinitiv or Thomson Reuters, and they claim that they measure the sustainable performance. So based on your research, does it mean that the claim is not true, or what do you suggest of the rating that we should use? Yeah.
Within the length of my sample, I would say no.
Oh.
I cannot predict what moves in the future, but within the sample that I have, I find that only the promises are in the ratings, and these don't seem to come true. So in aggregate, there seems to be not really a link between the ratings and the actual sustainable performance, even when I use their own data. Now, there are actually two types of ratings. Most people think that all ratings measure sustainable performance, but some of them don't. You have rating, you can basically see the firm in the middle, and then ESG on either the input side or the output side. You have ratings like Refinitiv and Vitra Iris that measure the impact of the firm on ESG. Let's say the output, how the firm affects ESG. Those ratings are supposed to measure sustainable performance. You also have the other ratings, like MSCI or Sustainalytics. They're more input type of measures, value measures, where they argue that they measure the effect of ESG on the rating, on the firm. So if a firm is very subject to climate change, then it has a lower rating. So a firm like a firm that's built very close to the sea is more likely to have a lower rating, not because it affects climate change, but because it is affected by climate change. A firm that is very good at extorting local water supplies has a very good environmental score because it's very robust against environmental boycotts and very good profitable, but not actually that sustainable. So there are these two types of ratings, value and values. I found that both of them seem to have this effect, but keeping that distinction in mind is very important because they measure clearly different things.
Yeah.
So how do we go? Oh, there are a couple of mentions in the chat. Sorry, one I cannot read, but the other one is in English. How do we identify promises and realize sustainable performance?
So the other one was just a reminder for the participant here, and the question was actually how to identify promise and realize sustainable performance. I think were you going to explain shortly? Is that?
Yes. So let's dive right into that. In order to measure sustainable performance, promised and realized, I actually look at the underlying information from the rating agency Refinitiv. So what I do, I look from 2003 to 2020 on all their granular sustainable performance, which are about almost 500 granular items of ESG, which means that they're very detailed. And I have this information for about 85% of global market cap. So they're really, really comprehensive scope. I don't look at non-financial firms. So I throw away all banks, insurance companies, REITs, real estate companies, stuff like that. All of that is out of the sample because they're just not representative to firms. And then I still retain 85% in 2020, which is 90 trillion US dollars, which, yeah, it's really, really comprehensive. Of these firms, about 3,000 are in the US, 1.5K in Eastern Asia, 1.4K in Western Europe, and a lot of other firms in other parts of the world. So there's a pretty broad coverage of many different firms with very detailed information in a somewhat timely manner. And just to give you an example of how this looks like, right? If I want to distinguish what firms promise and what they realize, I need to have these indicators on topic level, just for greenhouse gases, because everybody can imagine how that looks like a little bit. I don't only have how much they pollute their CO2 emissions, but I also have information on whether they have policies related to that, whether they do emission trading, whether they have targets related to emissions, and how high these targets are. If you look at human rights, I have information on whether they have human rights policies, whether they have human rights teams, and whether they have human rights controversies. If you look at labor conditions, I have information on how many minority people they hire, how many women, and whether there are wage gaps, in addition to whether they have policies on these topics. So I can very carefully compare what firms say they're going to do to what they're actually do. And this allows me to segregate promises from realizations. So to put it mathematically, these promises are the reporting, policies, activities, and targets, and the realizations are the controversies and performance. So basically, everything that you say you're going to do but haven't done yet, and everything that you have actually done without necessarily saying it. And what I do is I adopt a method from medicine that allows me to rank order the relative performance of basically anything. So for those of you who study mathematics, it's a weak dominance argument. So to put it graphically here on the equations, what I basically argue is that firm F is better than firm F prime if it is better in every indicator, or better or equal in every indicator, and at least better in one. And if it's so, I give the firm a value of 1 compared to that other firm. And I check all of these firms. If it's worse, it gets a -1. If it's indecisive, for example, one firm is very good on E, but very bad on S, then it gets a 0. And I add up all of these things together to create a rank, which are ordered from 0 to 10. So to elaborate a little bit more intuitively, for every firm within an industry, within a point in time, I look how well they're doing compared to the other firms in that industry and in that point in time. And because of that, I can very carefully track and compare firms that should be relatively similar at a similar point in time to assess how well they're doing compared to their peers. And if I split this up by parts, promises and realizations, I get two separate measures. And that's what I do to identify this rating inflation. Are there any questions so far? I know this is a little bit technical. This is how technical it gets, but I still like to make sure that everybody's on the same page.
Since you are saying that this is technical, so I allow myself to ask this question then. I still couldn't get the really technical part of it. So what you're saying, or is there any specific, say, numbers or statement or anything that you look through the reports or the whatever the numbers that you're looking at so that you can come up with this separation?
Yes. So what I do is I very carefully look at this Refinitiv ESG dataset, which collects information from company reports, from NGO reports, from government statements, and from news outlets. And they pull all of this information together into one dataset. And then what I do is for every variable, like here, can you see my mouse?
Yeah.
Okay, so for every variable in the sample, I carefully look at what the item is, and then I give it a specific type. So here it states emission policy, which then is a policy, or emission target, which is a target. So it's often quite clearly labeled what each thing is supposed to measure. When it's not, I look at the description, and then it becomes almost always very obvious. There are only a handful of them that are really a little bit unclear, and these are just removed from the sample. So it's often very clear whether it's a policy, a performance, activity, or target. And by splitting it in this way, you get a very clear overview of what firms are tending to do moving forward and what firms are actually doing right now. And then if you have all of that, you basically try to figure out how the firms are compared to each other. So you just sort all of them. It's like opening up Excel and sorting something, right? This is sorting something across multiple dimensions simultaneously and giving each an equal weight, basically. So if there's one firm that is Tesla and there's a firm that is Volkswagen, then Tesla is doing better environmentally than Volkswagen. So we assume everything else is the same. Then Tesla should be higher than Volkswagen. But if there's a firm called BMW, which maybe is better than Volkswagen, for instance, then that will always be higher than Volkswagen. But it could be indistinguishable from Tesla, because maybe BMW has a better social performance, but a worse environmental performance. So that one is not strictly better than the other. So we say that we cannot really compare them, and we skip over that observation. Then the rank would be a joint first place for Tesla and BMW, and a third place for Volkswagen. This is how that would look like. And I do this for all of the firms in your industry simultaneously, and then rank order them and give them a grade, basically, from 10 to very good to 0, very bad. How do you do that in Indonesia? Which grading scheme do you use? So you could say like, So getting a 10, a score of 10, will be getting a A+. And getting a score of 0 will be getting an F minus, if that exists. So it's really like, I translate it into a score like that. And then yes. And then I argue that a rating is inflated if and only if the ESG rating only capture the promises. So if the realizations are not at all considered in the rating, and then that needs to hold in addition to the following statement, when these promises should also not realize. And these are two really stringent conditions. Like I could simply argue, well, the rating is inflated. It doesn't currently capture the performance of the firm. But maybe firms that promise a lot will do great in the future. And we need to consider that fairly. Because if a rating works, it should consider these aspects carefully. And I argue that the rating is not working only if both of these conditions hold. So if only the promises are considered, not the realizations, and if these promises subsequently don't materialize. And you might wonder, does that actually happen? That's really stringent. And we need to do this in two separate analyses. So if we do that, and we look at this rating inflation, we basically find the following. So what I do here is I regress the promised and realized ranks that I've just made on the definitive MSCI and FTSE ESG ratings of firms. And what I find is that the promises are always persistently positively correlated with these ratings, which is good. You would hope that this is the case, because if you promise a lot and you're going to do it in the future, it should have a positive impact. So that's very positive. But then if you look at the realizations, there's actually a negative or neutral relationship between them and the rating. So it's kind of weird, right? If you promise a lot, you get a higher rating. But if you start doing more, your rating goes down. That's effectively what this tells us. And this controls for industry, company size, year, in which country the company is located, and also even controlling for firm fixed effects. So even saying this is a firm identical to another firm, and let's now see what happens over time within that firm. So the same firm in the same location with the same everything, only changing one of these aspects, what happens? So controlling for all of these things, we still find that there's a negative relationship between what they do and what they actually realize. And this is one of the key findings of the paper. Any questions? If not, then let's move on to a couple of examples. As I'm Dutch, I put in a couple of Dutch examples of firms to show you what happens. So in Cambodia, Heineken, a really large beer brewing company, had a lot of sales personnel. And this personnel was effectively, well, paid so little that they were forced into alcoholism and working under very bad labor conditions. There were even some reports about people renting themselves out in the cafes that they worked at in order to pay for their living. And this is just horrific in any way how you would possibly describe it. Now, what we look and see in the ratings is that actually during that bad period, which I've covered in gray, you find that the rating went up a lot. And the reason why that is because the firms reported strongly on these issues. They made a lot of claims to resolve these issues moving forward. Actually, they didn't do anything. And a lot of bad stuff happened during this period. But still the rating went up. That's not how it's supposed to happen. But it did. To give you another example, Shell. Well, I don't think I need to explain that firm in too much detail. But the old giant has currently a rating of 93 out of 100. That's basically an A+. So the firm has had a very good rating, very persistently over time, even though having controversies quite literally every year. And it's partially because it reports so well, not because it's doing any good. Another firm, a Dutch labor exchange. During the period of 2008, 2011, it started having very bad labor conditions in relative terms to what it did before. So as you can see, the realized ESG performance of the firm, which was really high, went downhill rather rapidly. And then it got delisted. But the rating of that firm actually went up over that time period because the firm started reporting a lot and kept doing so rather persistently. I could go on and on making new examples of what's happening here, but this should at least give some sort of an indication of which firms are doing good and are saying that they're doing good, and which of the two things actually affect the rating. Any comments? Any suggestions? Do you know a firm where you think, hey, well, what's going on?
So, with the previous example showing the controversies here as well, does it mean that even there is scandal, for example, the investors doesn't really care of what is happening with the company? Is that what happened, or how do you actually explain that part?
I would slightly differently mention it. I would say that in every of these years, there have been bad events related to ESG with the firm, but the rating doesn't capture it. And because investors use the rating, they also seem to not notice or less notice.
The rating doesn't capture, meaning the investor doesn't know because of the information asymmetry that you're claiming? Oh,
yes, at least to some degree.
Okay, right. There's one question here as well. Does it mean that most
yes.
ESG ratings mostly measured promises, and why?
Well, the first one, yes, full stop. The second one is a little bit more difficult to explain. So there are two things that could be reasoned why that's the case. The first one is the rating agencies know that there's a lot of information asymmetry. There's a lot of variance between these ratings. So they either hire a whole department to very accurately take into account the sustainable performance of a firm, or they hire less people, do a less good job, and save money. That's one argument. I'm not sure whether that's the whole reason or even part of it, but that's one of the arguments made in literature. Another argument that you can make is that this is interview evidence, so I'm not too sure whether I should believe it to the full extent. But there has been a paper by Clementino and Perkins, 2021 Journal of Business Ethics, that claims that firms can pay for a rating methodology workshop in which the rating agency explains how the ratings work and how to basically trick them for a price. So it could be part of a business model to do that. The same thing has been shown by Becker and Badhai in 2017 on a data set of Indian credit rating agency data. And it's a JFE paper, I believe. Very good piece for credit rating. So the mechanism exists before, and these rating agencies, which are also the credit rating agencies, could maybe possibly do that. Again, circumstantial evidence. Another reason is the work of Seraphim and Iwanu, which are at Harvard and LSE respectively. They argue in their working paper, Corporate Social Responsibility, a Strategy, ? That firms tend to follow each other in terms of environmental and social performance. Something becomes a trend, now everybody's using it. If your whole business model relies on one specific thing, and everybody seems to be copying it, are you going to share your trade secrets? Are then the good firms actually going to be incentivized to report? Because if you're a good firm and you say you're going to do something and you don't, you're hit a lot harder, says the work of Leona Maxwell, 2011. So there are a lot of arguments why this can happen. In all honesty, I cannot do that in this study. I don't know. This is all that I can speculate why this is going on. And it seems to align with what I find, but I cannot give you conclusive evidence. I just don't have the knowledge and data to do that right now. I don't have the numbers. I need to go inside of a rating agency to actually do it. And to test any of these things, we need to get some sort of a measure of corporate wrongdoing. And this is really difficult because they do a lot. They're big firms. They don't just make ESG ratings. They do a lot more. So it's really, really, really tricky to do that. But all I can say is there seems to be some incentive to do this, but I cannot guarantee you what exactly causes it. I hope this somewhat answers your question, but I can't tell you everything. But very valid question. I get it every presentation, and I give the same answer every presentation, and I still don't know how to answer it, and I leave it outside of the scope of the paper, but it's fun.
I was actually in this middle of session, a webinar, a debate between two experts from the CFA. Even those, they have quite a debate on that one. One said that this is something that should not be in there. Actually, this is just a way for people to earn something from becoming the raters, while the other said it is better to have something in place rather than nothing at all. So I guess in that sense, do you think this is also lots of avenue for the researcher, or is it something that we actually, after you're doing this, probably you think that, okay, it doesn't go anywhere, we should just leave it? Or on the other side, this is another avenue. What do you think?
No, it's completely another avenue. Like, if we stop with this, they're going to invent something new and similar and then do the same tricks again, right? Everywhere where there's a way how to make money, the firms will try to do that. Some of them will have good intent and accidentally do it wrong. Some of them will have bad intent and take use of it. Some of them will do good and actually do it. And we need to know which is which. So it's really important to keep studying this. We need to investigate and get more information out there, because without information, you don't know what you're buying. And if you don't know what you're buying, well, then you get the results that I'll show you in about a minute or two. So it's really important that we keep focusing on this. So if any of you wants to do research on this area or something, I would happily share the scores that I have in any way that could be used for research purposes. Please use them, validate them, show me that I'm wrong in some things, help me improve this work, because we need to do this together as a research community. One PhD student and a supervisor is not going to change the world. We try, but we need to have more force behind it. So yeah, I'd happily share most of the data that is not proprietarily by Refinitiv with you.
Thank you very much. I'll be the first one to raise hand then after this. Thank you.
Awesome.
You may continue, please.
Okay, so then if we look at what happens to these promises moving forward, well, what we actually find is that on average, these promises that firms make within the set of our sample don't seem to realize. One caveat here is that our sample ranges from 2003 to 2020. If we look 15 years ahead, which we do, also different intervals, of course, but up to 15 years ahead, the claims that we make are primarily for the firms at the start of the sample, when CSR was a little bit less prominent than that it is now. So for these firms, but also for the more recent ones, we find a generically negative relationship between promises and realizations. So the more you promise, the worse you do. And one way to explain that would be saying, I am a firm like Heineken. I'm now in trouble because I did something bad. So I'm going to do a whole lot of PR to try to convince people that I'm changing in the future. And then you do or don't. But it would at least explain a negative contemporaneous relationship between these two things. And if you subsequently don't follow through, then even a negative relationship altogether. And this holds for most aspects. But for greenhouse gas emissions, you see something strange. So initially, firms promise a lot and do nothing. In the middle of the sample, they promise a lot and still don't follow through. But at the end of the sample, they start slowly actually doing something. So there seems to be a change in the mindset of firms and investors regarding this effect. And already for wastewater management and business model resilience, which are closely tied to firm profits, this already existed before. So not everything's bad. There seems to be a change in the behavior of firms. And that's really promising. But so far in the past, it hasn't worked out as well as we might have liked yet. So now what are the consequences of this? Why? Why do we care? What happens if ratings are wrong? What can we do with that? And what do investors do with that? So what I do in this slide, I basically look at the effect of institutional investor holdings using 13 F forms from Refinitiv on the promised and realized ESG ratings of firms. So what I do, I look at all investors that are buying firms listed in the US, and I look at what this investor is and how much money they put in which firm. And then I say, okay, we calculate a share of institutional investors, which is basically the amount of banks, investment funds, pension funds, mutual funds, is everybody but you and me. All the big guys, all the big fish. And then look at whether they buy more firms when the rating is high. Well, the answer is very clearly yes. But then there's a distinction here. I split this sample by firms that sign a treaty by the United Nations to invest responsibly, the principles of responsible investing, and those that don't, which clearly separates the sustainable and the non-sustainable ones. And what I find here is that it's only the sustainable ones that highly buy these ratings, firms with higher ratings, and the other firms actually shun them. So they try to get away from these firms. And you can then argue, well, maybe it's by chance the firms that are very sustainable that are actually also having the highest ratings, and just because some of them are different, they buy those ones. Well, then what do? Is I look at the promises and realizations separately. And what I find is that these institutional investors, but only those that sign the PRI, buy the ones that have the inflated ratings. So for some reason, only the socially responsible investors that try to do good are the ones being fooled by the ratings. And this effect is really big. When a rating doesn't, when a firm doesn't report anything, and it suddenly reports on everything, it gains an inflow of almost 40%, 4% of its capital, which is really a lot. If we have a 90 trillion sample, that would be 3.6 trillion. That's really big. So it are large amounts of cash flows that move from the bad to the so-called sustainable firms based on the ESG rating inflation. So investors actually don't seem to know. And yeah, that's basically what I show here. And then if we just replicate this and see how it compares to the market benchmark, and if you buy the ones with the higher ratings, you're actually having 3 times as many controversies than if you would just to buy the market. So really, these ratings are order of magnitude off. They're really inversely related. This has a large negative impact on how socially responsible investors do business. So firms and cost of capital, can I take advantage of this? Let's make a preliminary regression, right? Let's just regress the ESG ratings on multiple cost of capital measures. What we find, higher rating, lower cost of capital. So if you inflate your rating, you can do more projects at a cheaper rate, earning you more money as a firm. And this could just be correlational. So let's now try to do something causal, some difference analysis. We try to investigate a shock to ESG rating inflation, which in itself should be hidden. So it's really difficult to find one. But we did. What we did is we looked at the European regulation that forces firms to report more strongly on their sustainable performance, but not actually improve the sustainable performance. So because the reporting was forced to go up, there is a shock in the promises that firms make, but not in the realizations. And as a result, the rating becomes inflated. Now, the beauty of Europe is that not every firm in Europe is part of the European Union, and thus not every firm is affected by this regulation. Switzerland is not, but it's pretty similar to Germany and Austria. They speak the same language, have the same culture, have very comparable in almost every aspect. So what we find is that if we take a look at that specific scenario, we see that there is about an 80 basis point cost of capital difference after the introduction of this regulation. This is really large. Honestly, I think it should be way smaller than that in practice. But for a 400 basis point average cost of capital, this will be something in the magnitude of like 30%. So it's really 20%. It's really, really big. In practice, I believe it's more like 30 to 40 basis points. But we find these numbers pretty persistently whatever we do. So there appears to be very large consequences on this rating inflation, both for the firm and for the investors. So we find, in a nutshell, that Refinitiv, MSCI, and FTSE ESG ratings are inversely related to sustainable performance. As a result, investors tilt away their funds from sustainable firms. This has a causal implication for cost of capital, and actually all of our responsible investing may be inversely related to the societal benefits thereof. So this basically starts up a debate on how these information asymmetries should be addressed. Because if we don't, we kind of allow our investors to invest in the wrong way. And we need to put this into the theoretical models. Alex Edmonds, Jan Schindler, and Doran Levitt are one of the first to accurately do that. You've also Arif Malfadol, 2021, and JV that makes a very good approach. So there's some useful literature that tries to do this, but we should incorporate information asymmetry when we assess this problem. And this has strong trade-offs for the tilting versus engagement. If you don't know which is which, buy something and change it from within is probably safer than buy something and hope for the best. And does really the ESG ratings work? Are they useful? Can we use them in practice? And how do we resolve such issues? The things that I came up with is force firms to report. If all of them are forced to report, not only on what they're going to do, but on what they're actually doing, you can more easily compare that. But in all honesty, is this enough? I don't know. If you force firms to report on everything, you standardize the way how to do business. So you kill creativity. But if you don't force them to report at all, you get this scenario, which also doesn't work. So there needs to be a golden balance between the two that allows for creativity, but also enforces them to report on specific aspects. And I don't know how the balance should lie. So if you have any thoughts on that, I'd love to hear them, because I genuinely don't know how to exactly operationalize it. I think something like this should work, but how? And yeah, if you have interest in the paper itself, I suggest that you scan this QR code or just use your phone to scan it, and you can take a look at the paper and maybe my other work as well. If you have any questions, just send me an email. I'd love to talk to you further or help you in any way that I can with research or applications like that. And these are the main things that I wanted to talk about today. But I'd also like to make a small sidestep. So Daisy in particularly asked me to take a look at developing countries, because we hear so much about the US and so little about the other part of the world. So if you take with me for like 5 minutes, let me quickly speculate of how this looks like in more developing countries. So can you still see my screen? You say yes if you can, or switch it on. Can you still see the screen? Can I go through the paper?
Sorry, your voice is broken. Can you say that again, please?
Oh, let me reshare my screen for a second. You see it now?
Yes, we can.
That's not this one either. Yes. This slide I will show you. So if I split my whole sample for multiple regions of the world, so I have a very detailed sample set, and I can very accurately assess where everything takes place. So if you look at specific parts, North America, Latin America, Western Europe, Eastern Europe, Western Asia, Eastern Asia, Middle East, Africa, and Oceania, in the following order, we find that there's a very persistent, again, positive effect for reporting and a often negative effect for realizations. The only somewhat outlier appears to be number 7, which from the last should be the Middle East or Eastern Asia. Check. So in the Middle East, some of the promises seem to come true, but it's only slightly significant, slightly statistically significant. And if you look at the other ratings, you again find that promises are strongly there, but realizations are often negative. So even for multiple parts of the world, it greatly matters how these ratings are built up. So it's pretty persistent because the investor base is quite similar. So they follow a similar investment strategy in different countries, and therefore they have the same funds. The paper that they have, it's got connected dots. How CSR approaches basically, are shaped. Why firms do ESG in a certain way. I try to tackle greenwashing from a risk mitigative approach, from strategic ESG. And what I find in this paper is that there is a large difference between how firms go about this. So if you look basically at the graph here, you find that initially a lot of firms were doing it strategically because nobody was pushing them to change. If you were doing ESG to start the sample, you were good guys. You could, and you did. And in the end, when everybody forced you to be sustainable, the amount of greenwashing vastly increased. And this is also relatively persistent across countries. So if you look at these shares from all parts of the world, basically, you find that it's very persistent. And it persists across all these aspects. So there is a lot of firm behavior. A lot of firms are trying to force to be sustainable. Then you see that they shift away from the center. So when we push firms a lot to become more sustainable, many of them we change for good, but some of them we force into greenwashing. And those firms actually offset the firms that are doing good to about the exact amount. So on average, there does not seem to be too much happening. So the findings that I have are relatively generalizable for both developed and developing countries across many parts of the globe. So unfortunately, you don't see that many differences between firms that are doing good on one aspect and the other across regions. So this was primarily my pitch for today, and I'd love to open up the floor for questions. Like anything I can do to help you understand, or some other questions related to the fields, please let me know if there's anything you'd like to ask. And just pop open your mic and talk to me.
Thank you very much, Bram. So, Bapak Ibu, colleagues, lecturer, if you have any questions, you may speak up. Probably we allow 1 or 2 questions before we end the session.
Yes, any question? Sorry, any questions? Or if not, I would like to ask Bram for your opinion, because Refinitiv has also issued the ESG controversies rating, right? Do you think this rating can close the gap between the promised and realized ESG? Can we use this controversy rating?
Honestly, I have not checked it.
Okay.
Maybe. What I have done is I've used RepRisk, and RepRisk is a different data provider that looks at reputational risk measured by media events for basically almost all firms. It's really detailed, even for non-listed firms. And what I've done is I put these data sets together, and I basically compared how these scores work. I can actually show you if you'd like. No, not that one. So also that one. Oh, sorry, I accidentally lost everything. My apologies. Let me quickly open up the paper. So what you get if you do the analysis on table B, before. So what you get here is if you use the RepRisk rating, you see it's actually negatively related to the promises. So it seems to show that it's really clearly not a promise. And it's positively related to the realization score that I have. even after controlling for a whole bunch of effects. And even nicer, it's way more strongly positively related to my controversy score. So there seems to be a relatively high persistency between the controversy score that I create and the one that rep risk gives. So if you have to use something, going for rep risk is a relatively safe choice. But rep risk is small. It only covers ESG news events related to the reputational risk of the firm. So it doesn't cover everything. It only covers a small amount of things. It does so very carefully and very accurately, and I like the firm a lot. But it only does so for reputational risks. My scores cover more than that, as you can also see in the regressions. They cover at least different things, and they're a bit broader in nature. So I would rely on rep risk scores. Or if you want, I could give you my own scores and you can use them moving forward. Are there any additional, or please respond, it's even nicer. Are there any additional questions you might have? Anything I could help you? Is there something you'd like to know about ESG or responsible investing or my paper in particular?
What about the other two ratings that you use? Do they also have the controversies rate? Are you looking into that as well?
I think FTSE doesn't have it. I'm pretty sure they don't. MSCI might, but I have not explicitly heard about it, so I don't know whether they do. Because they primarily capture the impact of ESG on firm profits, not the other way around. So their focus is only on controversies when it hurts profits, and therefore it's maybe less important. But I would need to check that. I've just used their main ratings to analyze. These controversy scores may be more accurate. Because it's a little bit harder to play with that, right? Those are not reported by the firm, but by the media or by an NGO. So that would hope it would were to be more accurate.
Yeah. Okay.
So what they do for the main ratings, they basically get all information and split it by topic. And then they average everything by topic. And then they give a certain weight to that by topic and not by type of promised and realized. And that's why this whole thing's happening. So if you open up the Refinitiv documentation, you see that they have like a couple of categories: human rights, emissions, energy use, something like that. And then they weigh all of these things across these topics, and they just average everything. And there's also a human component in it. I spoke with some of their people, and they also just use their own judgment at times. But this is how they generically construct these ratings.
Okay, right. Okay, I think, is there any more questions, Bapak Ibu? Okay, we have one question here. If Bu Desi, we still have a little bit of time, right, Bu?
Yeah, maybe the last question, maybe.
Okay, the last question. Bu Sari, please, you may ask your question.
Okay, thank you, Ms. Desi and Ms. Valentina. Good afternoon, Mr. Bram. Thank you for the insightful presentations. I really like your ESG scores, the promised one and realized one. And I'd like to ask, if I were an investor and I want to choose the right ESG score, for example, may I choose your realized ESG score? Because I think it's better than the MSCI and FTSI one. I don't know. Is it like, do you have any recommendation for the best ESG score? Thank you.
Thank you for the question. As a financial person, I always have to disclaimer, this is not investing advice. After having said that, I've done some analyses of this to see whether it actually works. So if you invest based on the scores that I make, based on the realized ESG scores, you get actually quite similar returns to the market. So there doesn't seem to be that much difference in my analyses. or use a 4-factor alpha model or a 5-factor alpha model or a 5-factor alpha model with momentum, you get quite similar financial performance. There's maybe a 1 or 2 basis point difference, but it was not statistically significant. It was really small. So it seems like there's not that much financial cost as of yet to investing in that way. And if you pull that one step further, there is the work by Pastor, Stambauch, and Taylor, 2022 Journal of Financial Economics, Dissecting Green Returns, that shows that right now, all of the investors are throwing in money towards sustainable firms. And as a result, they're increasing the prices. So if you're the ones to first identify the green firms, you might still be able to strike a profit out of it. In the long run, they will have a lower return. Because we care about it, we accept a lower return for these firms. But in the short run, while money is being thrown in hordes at these firms, the price must go up. So out of equilibrium, it's profitable. In equilibrium, it's likely costly. That will be my guess and my most accurate estimates. If you want, I could share my scores with you if you want to use it for academic purposes. Only academic purposes.
Thank you very much. Thank you.
You're welcome.
Thank you, Busari. But as you said, it takes time to actually get there, right? And it's supposed to be costly in a way in order for us to be there. Okay, I think that's the last question. And also end of your presentation. We are very thankful for the opportunity of today. So we have a very insightful presentation, a very critical analysis, and also an offer to contact you in person as well as to get some data from you. So I think after this, you will be emailed or being contacted by many of us. So hopefully we can also have some opportunities to somehow having research or being in the same network with you. So I think
likewise for me, it's always a pleasure to present and to talk and help people as much as I can. I mean, as an academic, you do research, but you do it to help people and you do it to make an impact. So if you do all of your work in an ivory tower and talk to nobody about it, it's not going to make a change. So I need to tell people about this and hopefully change their priors and see if that leads to something indirectly, but still.
Yeah.
Thank you.
And we also learn from you, since you are also a student, like many of us here who's currently taking our PhD. So this, of course, will inspire many of us here. So I think that's very much from me. And I think we will take pictures before we end the session, if you don't mind. Mas Heri?
Mas Heri, bisa ambil
apakah bisa dibantu untuk foto? Atau saya sambil coba juga ya foto ya?
Aku foto ya Bu ya?
Ya, silahkan. Bapak Ibu yang lain tolong dibuka kameranya supaya kita bisa berfoto untuk dokumentasi PPIA, silahkan.
Ya, silahkan yang berkenan dan bersedia membuka kamera ya.
Silahkan, Mas Heri, sudah bisa difoto, dimulai.
1, 2, 3. Ada lagi 1, 2, 3. Nomor kedua 1, 2, 3. Oke. Selesai.
Baik, terima kasih. Thank you very much, Bapak Ibu, Ibu Desi. Kembalikan ke Ibu atau saya langsung tutup Ibu?
Oh, langsung tutup aja.
Okay, baik. So everyone, thank you very much. Have a good afternoon and have a good morning to Bram. Hope we can see each other again in the next PPIA Bincang Akademik session. Thank you.
Yeah, thank you. Thank you, Bram. Thank you all.
Thank you all.
Thank you, Bram.
We may leave now.
Yeah.
Bye, guys. Hope it was
Bye.
interesting.
Yes, thank you.